So how are markets responding to that threat from President Trump to blockade the Strait of Hormuz himself? Well, unsurprisingly, oil prices are higher when you now have both sides willing to restrict the flow of oil and other commodities out of the region. Higher by the tune of 6.5% to 101.5, so a very big single-day move, 6.5%, and back above $100 a barrel once again, and clearly still a lot higher from where we started the war. Perhaps worth just dwelling on where we got down to last week, or only down to last week, because last week when we heard that there was a ceasefire in place, that there would be peace talks over the weekend in person in Islamabad, perhaps you could frame that as the single most optimistic moment of the conflict so far, and yet the oil price only got down to 95. Yeah, it's down from the peak of 117 a few weeks ago, but just worth pointing out how high it is relative to where we started the year. Back at the start of January, before the war, of course, began, we were about 60. So whether or not you're on a good news day or a bad news day in the war, you're still talking about higher to the tune of 45% or 50% or 60%. And it is worth just noting, therefore, that whatever's happened over the last couple of weeks, we're talking about much higher inflation prints here in the UK for the rest of the year. When we talk about inflation each month, the data that we get monthly, we're talking about year-over-year inflation. So we've got another 8-9 months or so of monthly data where the biggest input in terms of commodities, oil, is going to be up 40, 50, 60% either way, regardless of if it's a good news, bad news day in this particular war. What does that mean for UK borrowing costs? It means they're elevated and they're sticky higher. Good news moves down a bit, bad news moves back up again. We're about 4.25% this morning, off the peak of 4.5, but vastly higher from 3.5%. This is the one-year borrowing cost. A reminder, the Bank of England base rate is 3.75%. So before the war, we're expecting a cut. We now expect a hike or two during the course of this year. And again, small fluctuations in the grand scheme of things, whether it's good news or bad news over the course of the last week. Just want to end by showing what the US tech-heavy NASDAQ stock index has done during the course of the war. For context, this was April last year, Liberation Day, when President Trump announced those tariffs. The market responded to that terribly in the US. We saw a two-day move of 11%. Huge for two particular days, and a peak to trough move of 17%. And that was enough to pressure President Trump to U-turn, to step back from the brink, and markets have rallied since. Well, even at the trough last week during this particular war, before news of ceasefire talks, the pre-war to mid-trough of the war move in the US stock market was only down 5.5%. And in fact, by the end of last week, on hopes for those ceasefire talks, it was back to essentially flat. In fact, up 1% from before the war started. And that might be a reason why, once again, President Trump over the weekend decides to put his foot down again, to escalate things with this talk of a blockade. Because even though the polls are turning against him, even though there is, of course, pressure at the pump in the US, the broad US stock market hasn't really done much, certainly not as much as it did last April. And by the way, last April was quite an easy off-ramp for him. He just lowered the tariffs again. As we've learned over the last 6 weeks, the off-ramp for this particular crisis is incredibly complicated, much harder to put the genie back in the bottle. And this chart, at least, compared to those other two, seems to show a bit of complacency, whereas clearly oil prices remain very elevated over the course of the last week, whether it's a good news day or a bad one.